A 2024 study found that over 60% of retail traders lose money due to poorly defined strategies. That's not a typo. 6 out of 10 people are literally throwing their money away because they never figured out their trading style. Today, we're breaking down the core trading approaches, momentum, scalping, breakouts, and more. Specifically, how each one actually works, what personality types they suit, and how to pick the style that won't destroy your account. By the end of this episode, you'll know exactly which trading approach matches your goals and temperament.
So let's start with the big picture. What does it actually mean to choose a trading style? And why do so many people get this wrong?
Most people approach trading backwards. They see someone making money with momentum trading or scalping, and they think, I'll do that too. But here's the thing. Trading styles aren't just about profit potential. They're about matching your psychology, your available time, and your risk tolerance to a specific approach.
That makes sense. So let's break down these different styles. Start with momentum trading. What exactly is that?
Momentum trading is probably the most straightforward strategy for beginners because it focuses on something you can easily see: strength. According to DayTradeLab, when a stock is moving quickly in one direction with strong volume, it often continues in that direction for a short period.
So you're basically riding the wave while it's happening?
Exactly, but there's a structure to it. Momentum moves have 3 distinct phases. First is the ignition phase. That's when the stock wakes up due to news, earnings, or unusual volume. Price expands quickly with large candles and volume spikes.
Okay, so that's the initial burst. What happens next?
Then comes the control phase. The stock pauses and forms a small consolidation or pullback, but crucially, it holds above key support like WW or the breakout level. This shows early buyers aren't selling aggressively.
And the third phase?
The continuation phase. Once the stock breaks out of that consolidation with renewed volume, momentum resumes. This is where the cleanest entries happen because the trend is clear and volume supports the move.
That's fascinating. And there's actually optimal timing for this, right?
Absolutely. Momentum trading works best during the first 90 minutes of the trading day, when volume is highest and reactions are strongest. That's when you get those self-reinforcing moves where attention creates buying pressure, which attracts even more traders.
So it's like a snowball effect. Now let's talk about breakout trading. How is that different from momentum?
Breakout trading focuses on key levels where price has repeatedly failed to move higher or lower. When price finally breaks through with strong volume, it often triggers stop orders and attracts new traders, creating a fast, clean move.
So you're waiting for price to break through established resistance or support?
Right. And volume is absolutely critical here. According to research on breakout strategies, a breakout without significant volume is often a false signal or fake out. Volume provides the ultimate validation that the move is real.
What kind of patterns do breakout traders look for?
The classic ones are triangles, ranges with horizontal support and resistance, flags and pennants, and double tops or bottoms with clear levels. The key is that these patterns need to be obvious. The more eyes on a level, the stronger the reaction when it breaks.
And there are specific indicators that help confirm these breakouts?
Definitely. Volume indicators confirm participation. Momentum indicators like RSI gauge strength, and volatility tools like Bollinger Bands show when a breakout is likely to expand. When multiple indicators agree, confidence in the setup increases.
Now let's get into scalping. This sounds like a completely different beast.
Scalping is like being a sniper in the trading world. It's a very short-term method where trades are executed within minutes, sometimes seconds. Scalpers target small price movements and aim for a few pips or cents of profit each time.
How many trades are we talking about here?
Scalpers can make dozens, sometimes hundreds of trades in a single day. The idea is to accumulate profits from sheer quantity rather than relying on significant price changes. According to market reports, scalping is particularly popular in Japan's mobile trading market.
That sounds incredibly intense. What kind of person is suited for scalping?
Scalping requires razor-sharp reflexes and the ability to make quick decisions under pressure. You need to be extremely fast in execution and stay disciplined because hesitation means lost opportunities. It's definitely not for everyone.
What about the downsides? This can't all be upside.
Oh, there are significant downsides. Scalping is emotionally exhausting and mentally draining. You also face high transaction costs because of frequent trades, and it requires your full attention. You can't scalp while doing other things.
So it's like the difference between sprinting and marathon running. Speaking of different approaches, what about the technical side? Do these strategies require different tools?
Absolutely. For momentum trading, DayTradeLab recommends a 3-chart system, a 1-minute chart for execution with 9 EMA and WWAP, a 5-minute chart for trend confirmation, and a daily chart for big picture context.
And for breakout trading?
Breakout traders focus heavily on volume indicators, moving averages like the 20 EMA and 50 SMA, and volatility tools. The RSI is particularly useful. Readings above 60 show strength, and when RSI breaks above a downtrend line alongside price, it's strong confirmation.
What about scalpers? What do they need?
Scalpers need low spread, high liquidity markets and technical indicators like moving averages, Bollinger Bands, MACD, and WAP. But most importantly, they need Level 2 market data to see real-time order book changes and a broker with lightning-fast execution.
This brings up an interesting point about broker selection. Does your trading style affect which broker you should choose?
Definitely. According to broker comparisons, scalpers need brokers like Lightspeed Trading that offer execution speed measured in fractions of a second. Momentum and breakout traders can use a wider range of brokers, but they still need reliable execution and good charting tools.
Let's talk about risk management. Does this vary by trading style?
Risk management is crucial across all styles, but the approach differs. For breakout trading, research shows you should risk no more than 1 to 2% per trade. With a $10,000 account, that's $200 maximum risk per trade.
What about position sizing?
Position sizing should always be based on technical levels, not arbitrary dollar amounts. For breakouts, you typically place stops below the pattern for upward breakouts, or at the lowest point of the pattern. The key is maintaining positive expectancy across your system.
Now here's the million-dollar question. How does someone actually choose between these styles?
It comes down to 3 factors: your available time, your psychological makeup, and your risk tolerance. If you can only trade for an hour in the morning, momentum might work. If you want to trade all day but can't handle stress, scalping is out.
Can you give us some specific personality matches?
Sure. Momentum trading suits people who like fast setups and clear direction but don't want to be glued to their screens all day. Breakout trading works for patient traders who can wait for the right setup. Scalping is for adrenaline junkies who thrive under pressure.
What about people who are just starting out? Is there a best beginner strategy?
According to trading education sources, momentum trading is often recommended for beginners because it's visually obvious when a stock is in play. You don't need to predict reversals or read complex indicators, you're just following obvious strength.
But there are still ways to mess this up, right?
Oh, absolutely. The biggest mistake is chasing. Beginners see a stock running and jump in at the top. The key with momentum is entering on structured pullbacks, not chasing the initial spike. Without that structure, momentum becomes unpredictable.
What about the success rates? Do we have any data on which strategies work better?
Interesting question. For breakout strategies, research on gold ETF breakouts showed a 53% win rate, basically a coin toss. But the average gain of 4.1% was substantially higher than the average loss of 2.9%, which is what matters for profitability.
So it's not about being right more often, it's about making more when you're right?
Exactly. Your win rate times average win needs to be greater than your loss rate times average loss. That's the mathematical foundation of profitable trading, regardless of which style you choose.
Let's talk about something practical. Capital requirements. Do these strategies need different amounts of money to start?
Generally, yes. Scalping often requires more capital because you're making many small trades and need to overcome transaction costs. Momentum and breakout trading can work with smaller accounts, but you still need enough to properly size positions and manage risk.
What about the time commitment? How much time does each style actually require?
Scalping requires constant attention during trading hours. Momentum trading is most active in the first 90 minutes, so you could potentially trade part-time. Breakout trading can be more flexible since you're waiting for specific setups to develop.
Here's something I'm curious about. Can you combine these strategies, or should you stick to one?
Most successful traders eventually develop a primary style, but might use elements from others. For example, a momentum trader might use breakout principles to identify entry points. But when you're starting, it's better to master one approach first.
That makes sense. What about market conditions? Do these strategies work better in certain environments?
Absolutely. Momentum trading thrives in volatile, trending markets with lots of news flow. Breakout trading can work in various conditions, but needs clear support and resistance levels. Scaling actually works well in choppy, range-bound markets where other strategies struggle.
So there's actually a strategy for every market condition?
In theory, yes. But here's the key insight. Most traders fail not because they picked the wrong strategy, but because they don't match their trading style to their actual lifestyle and psychological makeup. The best strategy is the one you can execute consistently.
That's a really important point. What would you say to someone who's tried multiple strategies and keeps losing money?
Stop and do an honest self-assessment. Are you jumping between strategies because you're chasing profits or because you haven't found the right fit? Most people need to slow down, pick one approach, and really master it before moving on.
And here's maybe a contrarian take. Is there such a thing as a strategy that's too exciting?
Actually, yes. If your trading feels like gambling or gives you an adrenaline rush, you're probably taking too much risk. The best trading style is often the one that feels boring to you, systematic, rule-based, and emotionally neutral.
That's fascinating. So excitement might actually be a warning sign?
Exactly. Professional traders often describe their best trading days as boring. When you're following your rules and managing risk properly, it shouldn't feel like a roller coaster. That emotional neutrality is actually a competitive advantage.
So when you step back from all this, what's the real takeaway for someone trying to choose their trading style?
The real takeaway is that there's no universally best trading style. Momentum, breakouts, scalping, they all work for the right person in the right circumstances. The key is honest self-reflection about your goals, time availability, and psychological makeup.
And here's what I think people miss. This isn't just about making money. It's about finding a sustainable approach that you can stick with long term, even when things get tough.
Absolutely. The statistics show that 60% of traders lose money due to poorly defined strategies. But the flip side is that 40% do succeed, and they succeed because they found an approach that matches who they are, not who they think they should be.
Perfect. So here's your action step. Before you place another trade, ask yourself 3 questions. How much time can I realistically dedicate? What's my actual risk tolerance? And what type of decision-making process suits my personality? Answer those honestly, and you'll be way ahead of that 60% who are just winging it. Remember, the goal isn't to find the most profitable strategy, it's to find the strategy that's most profitable for you.